Welcome to CMA USA Exam Coach, your trusted companion for mastering key CMA topics in a simple and clear way. In today's episode, we're going to explore an important area of financial strategy, corporate restructuring. Now, when you hear the term restructuring, you might immediately think of a company in trouble, but that's not always the case. Corporate restructuring is a broad concept. It involves major changes in a company's structure, operations, or finances to improve efficiency, reduce costs, or prepare the business for growth or a new strategic direction. Whether it's merging with another company, spinning off a division, or renegotiating debt, restructuring plays a key role in how businesses adapt to change and create long-term value. So in this session, we'll break down what corporate restructuring means, the different types, and why companies choose to restructure. We'll keep it practical and easy to follow, just the way CMA students like it. Corporate restructuring refers to the process through which a company makes significant changes to its internal structure, financial setup, or operations in order to improve its performance or respond to changing business conditions. This isn't just a simple business adjustment. It's a major transformation that affects how the company functions, how it's financed, and sometimes even how it's perceived in the market. Restructuring can involve anything from selling off a business unit, reducing workforce, reorganizing the management structure, renegotiating debts, or even merging with another company. These changes are typically driven by the need to improve financial stability, enhance operational efficiency, or prepare for future opportunities. One important thing to understand is that corporate restructuring is not always a sign of weakness. While it's true that companies often restructure during financial distress, many successful businesses restructure proactively to remain competitive, enter new markets, or shift focus toward their most profitable areas. It's also a key strategy during mergers and acquisitions, or when a company wants to simplify its structure to make decision-making faster and more efficient. Through restructuring, a company might reduce costs, streamline operations, improve asset utilization, or increase value for shareholders. The characteristics of corporate restructuring usually include long-term strategic thinking, significant change in resources or processes, and a clear focus on financial improvement or business sustainability. It's not a minor adjustment, it's a strategic realignment of the company itself. So in summary, corporate restructuring is a big step, often necessary for survival or growth, and it requires careful planning and execution to achieve the desired results. Let's now explore the key types of corporate restructuring and understand what each one really means, along with how they are structured, both legally and operationally. Let's start with the merger. In a merger, one company is absorbed into another company. That means the company being merged will be dissolved and will no longer exist as a separate legal entity. The surviving company continues to operate, now including the business of the merged company. In equation form, this is written as A plus B equals A, or sometimes A plus B equals B, depending on which company survives. This type of restructuring is often done to expand market reach, increase efficiency, or reduce competition. Next is consolidation. In a consolidation, two or more companies come together to form a completely new company. Unlike a merger, in this case, both original companies cease to exist, and a new entity is created from scratch. In equation terms, this is represented as A plus B equals C. This form is used when both companies want to start fresh under a new identity, combining their resources, management, and operations equally. Now let's look at acquisition. In an acquisition, one company takes over another, but both companies continue to exist as separate legal entities. The key point here is that the ownership of the acquired company is transferred to the acquiring company. So, even if the brand name and operations continue, the control now belongs to the new owner. This type of restructuring allows the acquiring company to gain quick access to new markets, products, or technologies. Next, we have the joint venture. A joint venture is a collaborative arrangement between two or more companies formed for a specific purpose, for a limited time, or in a specific region. The companies agree to pool resources, share risks, and jointly manage the new business or project. Unlike a merger or consolidation, the original companies remain independent, and the joint venture exists as a separate entity only for the agreed scope. And finally, let's talk about acquisition of assets. Here, a portion of one company's assets is purchased by another company. This could include buying a product line, a factory, a brand, or intellectual property. The selling company continues to exist, but it no longer owns the specific assets that were sold. This form of restructuring is often used when the buyer is interested in only a part of the business rather than the whole company. Each of these restructuring types has different legal, financial, and operational effects. They are chosen based on what the company is trying to achieve, whether it's growth, efficiency, survival, or entry into a new market. Now that we've discussed the types of corporate restructuring, let's look at some strategic approaches companies use when deciding how to restructure. These are known as corporate structure strategies, and they guide the direction of mergers, acquisitions, and business combinations. The first one is the horizontal strategy. This involves combinations between companies that operate in the same industry, in other words, competitors. For example, in India, two telecom provider Idea and Vodafone merge and became VI. That's a horizontal strategy. The purpose here is often to increase market share, eliminate competition, benefit from economies of scale, or combine resources like technology or distribution channels. So, it's about strengthening a company's position within its current industry. Next is the vertical strategy, which is a bit more complex. Vertical strategies involve combinations between companies that are at different stages of the same supply chain. This can be broken down into two parts: backward integration and forward integration. Let's start with backward vertical strategy. This occurs when a company decides to acquire a supplier, someone who provides the raw materials or components needed for its own product. For example, imagine a car manufacturer buying a tire company. That's backward integration. The idea is to gain more control over the production process, ensure a stable supply, and reduce costs. Now on to forward vertical strategy. This is when a company moves closer to the customer by taking control of the distribution or sales process. Let's say a furniture manufacturer acquires a retail store chain to sell its own products directly to customers. That's forward integration. It helps the company better manage pricing, customer experience, and overall profitability. And finally, we have the conglomerate strategy. In this approach, the combination happens between companies from completely unrelated industries. Unlike horizontal or vertical strategies, a conglomerate strategy doesn't aim for industry-specific synergy. Instead, it's about diversification. For instance, if a clothing company acquires a food packaging business, that would be a conglomerate strategy. The goal here is often to reduce overall business risk by spreading investments across unrelated sectors. These corporate structure strategies are used to define the direction of restructuring, whether a company wants to dominate its current market, control more of its supply chain, or diversify into entirely new areas. To better understand how a conglomerate strategy works in the real world, let's take the example of one of India's largest and most diversified companies, Reliance Industries. As shown in the pictorial representation on your screen, you can see how Reliance has expanded into a wide range of sectors. It's not just one business, it's a group of companies operating across completely different industries. In the core sector, Reliance started with oil to chemicals. This includes petroleum refining, petrochemicals, and related manufacturing. This is their traditional business and still a major part of their operations. Then they expanded into digital services through Jio, which revolutionized the telecom and internet space in India. From oil and gas to mobile data and digital platforms, that's a major strategic shift. They also moved into retail and consumer brands, operating large-scale supermarkets and launching a wide range of FMCG products across India under the Reliance retail brand. Next, there's entertainment and media. Reliance owns stakes in movie production houses, music streaming platforms, and television networks, including Viacom 18 and Jio Cinema. Again, this is a completely unrelated industry from their core oil business. And now they are investing heavily in new energy, focusing on solar power, green hydrogen, and other renewable energy sources to prepare for the future of sustainable energy. You may already be familiar with many of these companies under the Reliance umbrella. And this is exactly how a conglomerate strategy works. Rather than depending on a single business line, Reliance has diversified across unrelated sectors. This helps spread risk, capture new market opportunities, and build long-term value across multiple industries. So Reliance is a classic example of how conglomerate restructuring can position a company as a multi-sector powerhouse. Now let's talk about something very important. Why do companies go for business combinations? In other words, what motivates one company to merge with or acquire another? This is what we call a business combination, where two or more companies come together and operate as a single entity. This could be through a merger, where both companies combine and operate together, or through an acquisition, where one company buys out the other. But what are the reasons behind such decisions? Let's break it down step by step and understand the strategic reasons that drive these combinations. The first major reason is economies of scale. Now, what do we mean by that? When companies merge, they become bigger. And when a company becomes bigger, it can reduce its average cost per unit. For example, they might combine their warehouses, share office spaces, or eliminate duplicate departments like HR or accounting. As a result, the merged company can operate more efficiently and at lower cost. This cost-saving advantage from operating at a larger scale is what we call economies of scale. It's one of the most common and powerful reasons behind a merger or acquisition. Next comes complementary resources. Sometimes two companies have different strengths. One company might be very good at manufacturing, while the other has a strong sales and marketing team. On their own, they're good, but together, they're even better. By combining, they get access to each other's resources, technologies, customer bases, and expertise. This type of business combination is all about synergy, where 1 + 1 becomes more than 2. It allows both companies to do things they couldn't achieve individually. Our third reason is sales enhancement or improved technological capabilities. A company might merge with another firm to boost its sales, enter new markets, or upgrade its technology. Let's say one company has a fantastic product, but not enough reach or distribution. And another company has a strong sales network. If they combine, the product can reach many more customers, leading to higher sales. Or in another case, a larger company might acquire a smaller, innovative startup to gain access to cutting-edge technology, instead of spending time and money building it themselves. So this type of combination helps a business grow faster, become more competitive, and improve its technological edge. Reason number 4 is management improvements. In some cases, one of the companies simply has better leadership and internal systems. Maybe they have a stronger financial control system, better project management, or more effective strategies. By combining with a company that's better managed, the overall business performance can improve. It's like a weaker team hiring a strong coach. It leads to better direction and results. This is especially useful when one company is struggling due to poor leadership, and a business combination can bring in new, more capable management. Our fifth reason is tax benefits. This is more of a financial strategy. Let's say one company has high profits and pays a lot in taxes, and another company has been making losses, but those losses are still recorded and can be used to offset future income. If these two companies merge, the profitable company might be able to use the losses from the other company to reduce its tax burden. In addition, the new merged entity might qualify for tax deductions or better tax structures depending on the way the deal is structured. This can result in significant savings over time. Of course, everything must follow tax regulations, but tax planning is still one of the motivators for business combinations. Reason number 6 is diversification. Now, imagine a company that only sells one type of product or operates in one region. What happens if demand for that product falls or the economy in that region goes down? That's a big risk. So companies often combine with others that operate in different sectors or different markets. This way, they spread their risk across multiple areas. If one part of the business suffers, the other part might still perform well. This is what we call diversification, and it helps companies stay more stable, especially during uncertain times. And finally, the 7th reason is lower financing costs. When companies become bigger through mergers or acquisitions, they often get access to better financing options. Banks and investors usually see larger companies as less risky, so they offer lower interest rates, better credit terms, or easier access to funding. Also, bigger companies can issue bonds or shares in larger quantities and at better rates, which makes it easier to raise money for expansion. So, by combining, companies can reduce their cost of capital and improve their ability to invest in future growth. Now let's understand an aggressive and often controversial strategy in the world of corporate restructuring, hostile takeover. So, what exactly is a hostile takeover? A hostile takeover occurs when one company tries to acquire another against the wishes of the target company's management or board of directors. In a normal or friendly acquisition, both companies agree to the deal. But in a hostile takeover, the acquiring company bypasses the management and goes directly to the shareholders, or tries to replace the management altogether to force the deal through. So in simple terms, it's like someone trying to take over a company without its consent. Now, how does a hostile takeover actually happen? There are a few common methods. One of the most used strategies is called a tender offer, where the acquiring company offers to buy shares directly from the shareholders at a premium price, hoping to get a controlling interest. Another method is a proxy fight, where the acquiring company convinces existing shareholders to vote out the current board of directors and replace them with new members who support the takeover. So why does a company attempt a hostile takeover? There can be several reasons. Sometimes the acquiring company sees hidden value in the target company that is not being utilized properly by the current management. It could also be a strategic move to gain access to new markets, technology, or customer bases. And in some cases, it may be purely financial. The acquiring firm believes it can make the company more profitable under new leadership or structure. Now let's take a real-world example that made global headlines: Elon Musk's takeover of Twitter. In 2022, Elon Musk launched what eventually became a hostile takeover bid for Twitter. At first, Twitter's board resisted the move. They even tried to block the acquisition by adopting a poison pill strategy, which is a defense tactic we'll talk about soon. However, Musk made a direct offer to the shareholders at a premium price, offering around $44 billion. Over time, pressure from shareholders and legal complications pushed Twitter's board to accept the offer. Eventually, the takeover was completed, and Musk became the new owner of Twitter, later rebranding it as X. This is a classic and high-profile example of how a hostile takeover works in the real world, even when it involves major global corporations and powerful boards. Now that we've understood what a hostile takeover is, let's look at how companies defend themselves from such threats. When a company suspects that someone may be trying to take over control against their will, they can activate what's known as anti-takeover strategies or defensive tactics. These are classified into two main categories: pre-offer defenses and post-offer defenses. Let's begin with pre-offer defenses. These are proactive strategies that companies put in place before any takeover offer has been made. The goal is to prevent a hostile bidder from gaining control easily. But you may wonder, how does a company even know that a hostile takeover might be coming? Here's how they find out. Usually, one of the first warning signs is when an outsider, often another corporation or investor, starts quietly purchasing more and more of the company's shares in the open market. This is done gradually, and the buyer might try to stay under regulatory radar by buying just below public disclosure thresholds. But if the company's management sees that someone is accumulating a significant percentage of shares, they may realize that a hostile takeover attempt is being prepared. This triggers the need for defense. So in anticipation of such events, companies adopt pre-offer defenses. These may include special clauses in corporate bylaws, restrictions on share transfers, staggered boards, or mechanisms that give loyal shareholders more voting power. The idea is to make it structurally difficult or costly for anyone to seize control without consent. Now let's move to post-offer defenses. These are reactive strategies used after a hostile offer has already been made, when the acquiring company makes its intentions public and approaches shareholders with a tender offer. At this stage, the company responds quickly to protect itself. The focus shifts to buying time, discouraging the acquirer or forcing negotiations on better terms. Post-offer defenses are all about slowing down the process and giving the company breathing space to evaluate its options. So to summarize, pre-offer defenses are preventive and long-term, set up to discourage any takeover attempt before it happens. Post-offer defenses are immediate responses, activated once a hostile bid is underway. In the next slide, we'll discuss the actual defense techniques used in both cases, such as poison pills, golden parachutes, and white knight strategies. These are the tools companies use to fight back and stay in control. Let's now talk about the pre-offer defense techniques. These are the actions a company can take before any takeover bid actually happens. Think of them as the company preparing itself in advance, just in case someone tries to take control without approval, which we call a hostile takeover. Let's now explore each of these techniques in detail with full explanation. First, staggered election of board members. Let's imagine a company has 9 members on its board of directors. Now, instead of all 9 being elected every year, the company divides them into 3 groups, or what we call classes. Each year, only one group is up for election. So in year 1, only 3 members can be replaced. The next 3 come up for election in year 2, and the final 3 in year 3. This is called a staggered board, and it slows down any outsider, like a hostile bidder, who wants to take control of the company by replacing board members. Even if they gain ownership of the company, they'll need to wait a few years to fully control the board. And that waiting period can be a major disadvantage for them. Second, supermajority merger approval provisions. Now, in most companies, if more than 50% of shareholders agree, a merger or acquisition can move forward. But with a supermajority provision, the rule changes. The company might now require 70% or even 80% of shareholders to approve a merger. This makes it much harder for a hostile acquirer to succeed, because even if they buy a majority of shares, they still won't have enough votes to push the deal through. It's like raising the bar for approval, giving more control to existing shareholders, and protecting the company from unwanted takeovers. Third, fair merger price provision. This is all about protecting shareholders from being treated unfairly. Let's say a potential acquirer is buying shares secretly at $60 per share from a few large investors. Later, when they make a public offer to buy the remaining shares, they offer only $45 per share. That's unfair to the remaining shareholders, right? The fair merger price provision ensures that everyone is treated equally. It says the price offered in the merger must be at least as high as the highest price the acquirer paid for shares in a certain period, for example, in the past 12 months. So if they paid $60 before, they have to offer $60 to everyone else too. Fourth, golden parachute. The golden parachute is a fancy term, but the idea is simple. It's an agreement made between the company and its top executives, like the CEO or CFO, saying that if they are removed from their job after a takeover, they'll receive a large financial package. This package may include a big cash payment, bonus, stock options, or other benefits. Why is this a defense strategy? Because it makes the takeover more expensive. The acquirer knows that if they succeed in the takeover, they'll have to pay huge sums to top executives. That can discourage them from even trying. Fifth, poison pill, shareholder rights plan. Now this one is very famous and very powerful. Here's how it works. If any shareholder, including a hostile bidder, tries to acquire more than a certain percentage of shares, usually around 20%, then all other shareholders are given the right to buy more shares at a discounted price. This creates what we call dilution. The value of the hostile bidder's shares goes down because many new shares enter the market, and now they own a smaller percentage of the company. In simple terms, the more they try to buy, the weaker their control becomes. That's why it's called a poison pill. It harms the hostile bidder, not the company. Sixth, poison put. This is similar in name, but it's a different idea. Here, the company has issued bonds to raise money, and these bonds have a special clause called a poison put. The clause says that if the company is taken over, bondholders, the people who lent money to the company, can demand immediate repayment of their bonds. Now imagine this. During a takeover, the company is already under financial pressure. If bondholders suddenly ask for their money back, it creates a huge cash burden on the company. And that makes the company less attractive to any bidder because they now have to handle a massive payment immediately after acquiring the company. Seventh, voting rights plan. This is all about control, not ownership. In this plan, the company issues different classes of shares, some with more voting power than others. For example, Class A shares may have 1 vote per share, but Class B shares may have 10 votes per share. So even if a hostile bidder buys a large number of shares, they might only get Class A shares, meaning they get very limited voting power. Meanwhile, the founders or existing management may own fewer shares, but with higher voting rights, they stay in control. This way, the company can stay independent, even if ownership starts to change. So to wrap up, all of these strategies are designed to make a hostile takeover slower, more expensive, and less rewarding. Now that we've understood pre-offer defenses, which are put in place before any takeover attempt, let's move on to the next category: post-offer defense techniques. These strategies are used after a hostile bidder has made their move, or after a takeover attempt becomes known publicly. So at this stage, the company is no longer preparing in advance. They're now responding to the actual threat. Let's explore 4 key post-offer defenses one by one. First, issuing new stock. This is one of the fastest ways a company can react to a hostile bid. Here's how it works. Once the company receives a takeover offer, they quickly issue a large number of new shares to existing shareholders or even to friendly investors. By doing this, they increase the total number of outstanding shares. This causes something called dilution. It reduces the percentage of the company that the hostile bidder owns. So even if the bidder owned 30% of the company before, after new shares are issued, their stake could fall to 20% or less, making it much harder for them to gain control. This move also makes the takeover more expensive, because now the acquirer would need to buy even more shares to reach a controlling interest. Second, Pac-Man defense or reverse tender offer. Yes, the name sounds funny, but the strategy is serious. The Pac-Man defense is named after the video game where the character being chased turns around and eats the attacker. That's exactly what the company tries to do here. Instead of sitting back and waiting to be taken over, the target company launches a counteroffer to buy the shares of the acquirer. So if Company A is being attacked by Company B, now Company A tries to buy out Company B instead. This is called a reverse tender offer, and it's used to turn the tables. Sometimes, the target company may also look for a white knight. That means a friendly third-party company that agrees to step in and buy the target, helping it avoid the hostile takeover. The white knight is seen as a better option, one that respects the target company's management and culture. So in this approach, the company either fights back directly or escapes into the hands of a trusted friend. Third, lockup provision. This is another powerful defense tactic, and it often involves something we call the crown jewels. The crown jewels refer to the most valuable assets of the company. It could be a highly profitable division, a key patent, or a major contract. In a lockup provision, the target company signs an agreement with a third party, often a white knight, giving them the right to purchase these valuable assets if a hostile bidder takes over. This makes the target company less attractive to the hostile acquirer, because if the deal goes through, they won't get the crown jewels. Those valuable parts will already be locked away. Think of it like this. The company is saying, if you forcefully take me over, you'll be left with the shell, not the treasure. This discourages the acquirer from continuing with the hostile attempt. Fourth, leveraged recapitalization or restructuring. This defense strategy is about changing the company's capital structure, usually by taking on a large amount of debt. Here's how it works. The company borrows a huge sum of money and uses it to either buy back its own shares or pay a large special dividend to shareholders. This has 2 effects. It reduces the number of shares available, making it harder and more expensive for the acquirer to gain control. It makes the company heavily leveraged, that means full of debt, which is not attractive to a hostile bidder. Why? Because taking over a company with high debt increases the risk and reduces future profitability. This type of financial restructuring can also include selling off some divisions or assets to raise cash, which further complicates the takeover process. So, the main goal of leveraged recapitalization is to make the company less desirable and more difficult to acquire. To summarize, post-offer defenses are reactive strategies. They are used after a takeover bid has been made, and they focus on blocking, discouraging, or increasing the cost of the hostile takeover. We looked at 4 key defenses. Issuing new stock to dilute ownership, the Pac-Man defense, fighting back with a counteroffer or calling a white knight, lockup provisions that protect the crown jewels, and leveraged restructuring to increase debt and make the company less appealing. Let's explore the concept of divestiture and understand how it's used as a strategic tool to increase shareholder wealth. So what exactly is a divestiture? A divestiture happens when a company decides to sell off a part of its business. It could be a product line, a division, or even an entire subsidiary. Sometimes, the company might even exit an entire market or country. And in some cases, the company may be sold off completely. Now, this may sound like a negative thing at first, but actually, divestitures can be very strategic and beneficial, especially when the goal is to increase efficiency, reduce losses, or unlock hidden value. Let's now look at some common reasons why companies choose to divest. The first major reason is bankruptcy. When a company is no longer able to meet its financial obligations, for example, it's unable to repay loans, pay salaries, or manage its liabilities, it may face the risk of bankruptcy. In such situations, one of the survival options is to sell off parts of the business to generate cash. This could involve selling profitable divisions, land, buildings, or even intellectual property, anything that can bring in money and help the company reduce debt. So in bankruptcy situations, divestiture becomes a last resort measure to recover as much value as possible for the creditors and possibly keep some part of the business alive. The second reason is cutting back on locations. Let's say a company operates in 15 countries, but they find that performance in some regions is consistently weak. Maybe the demand is low, the costs are high, or they simply don't have enough market share in those areas. Instead of trying to fix everything, the company might choose to exit specific geographic locations. This could mean closing stores, shutting down factories, or selling entire foreign subsidiaries. By doing this, the company can focus its energy and resources on core markets where it's more competitive, instead of wasting money in places that don't deliver good returns. This is a smart way to optimize operations and protect shareholder wealth. Now let's look at the third and most important reason: selling losing assets. This is one of the most strategic and commonly used forms of divestiture. Sometimes, companies own businesses or assets that are simply not performing well. These might be a product line that is outdated and no longer profitable, a business division that consistently reports losses, or an asset that doesn't fit with the company's long-term goals. Holding on to such assets can drag down the company's overall financial performance. It wastes management time, consumes working capital, and reduces investor confidence. So instead of holding on, the company chooses to sell the losing asset, even if it's at a loss, and use that money to pay off debt, invest in more profitable areas, or return value to shareholders through dividends or buybacks. Let's take a simple example. Imagine a company that owns 3 divisions, A, B, and C. Division A and B are profitable, but Division C has been losing money for the last 4 years. It's eating up resources and producing negative cash flow. In this case, selling Division C could immediately improve the company's profit margins, reduce distractions, and help management focus on the successful areas of the business. Even better, if the divested unit is sold to a buyer who can operate it more efficiently, both companies benefit. And the market usually rewards the selling company with a higher share price because it's now leaner, more focused, and more profitable. That's why divestiture is often seen as a value-creating move, not a sign of weakness. To summarize, divestiture is a powerful strategy where a company decides to sell part, or in some cases, all, of its operations in order to improve financial health and focus on what really matters. The common reasons for divesting include bankruptcy, where cash is urgently needed to pay off liabilities, cutting back on underperforming locations to focus on more profitable markets, selling off losing assets to eliminate financial drains and reallocate resources to better opportunities. Now let's explore the different types of divestitures that companies can use. Each one is different in structure and purpose, but all of them are used to change or reduce the size of a business in some way. Let's go through them one by one. First, voluntary corporate liquidation. This is when a company makes a decision to completely shut down operations and sell off all of its assets. Now, this is not always a sign of failure. Sometimes it's a strategic move. Maybe the company has completed its purpose, or maybe the founders decide to exit and distribute the value to shareholders. In this process, the company sells all it owns, like property, machinery, brand rights, and even inventory, and uses the proceeds to pay off debts. Whatever is left is then given to the shareholders. This is called voluntary because the company itself chooses to wind down, not due to court orders or bankruptcy. Second, partial asset sale. This is one of the most common types of divestiture. Here, the company doesn't shut down. Instead, it sells a specific part of its assets or business. It might sell a non-core division that no longer fits the long-term strategy, a group of stores that are underperforming, or a product line that isn't profitable. The rest of the business continues as usual. Let's say a retail company has 3 brands and one of them is not doing well. Instead of managing all 3, the company sells off the underperforming brand and uses the money to strengthen the remaining 2. This helps improve focus, efficiency, and profitability. Third, Corporate spin-off. A spin-off is when a company separates part of its business into a new independent company and gives the shares of this new company to the existing shareholders. So the original shareholders now own two companies, the parent company and the spin-off. This is done when a division is successful and can operate on its own. By spinning it off, both companies can focus on their own goals and performance. It also allows investors to value each company separately, which may increase shareholder wealth. A real-world example would be when a large company spins off its technology arm into a separate company so that both can grow in their own way. Fourth, equity carve-out. An equity carve-out is similar to a spin-off, but instead of giving shares to existing shareholders, the company sells a portion of its subsidiary to the public through an IPO, or initial public offering. So now, the parent company still owns part of the subsidiary, but outside investors can buy shares too. This allows the company to raise cash from the market, unlock the value of a fast-growing division, and still retain some level of control. For example, if a company's software division is growing quickly, it might carve it out and list it as a separate company on the stock market. This brings in new capital and shines a spotlight on that business's potential. Fifth, going private. This is a major strategic move. Going private means a public company decides to delist from the stock exchange and become a privately held company. This usually happens when the owners or private investors, such as private equity firms, buy out all the outstanding shares from the public. Why do this? Well, running a public company comes with strict regulations, public scrutiny, and quarterly performance pressure. By going private, the company can restructure more freely, focus on long-term goals, and avoid public market volatility. It's especially common when a company is undervalued in the stock market and wants to unlock its true value behind the scenes. Sixth, leverage buyout, or LBO. This is a special type of going private. In a leveraged buyout, a group of investors, often a private equity firm, buys a company using a large amount of borrowed money or leverage. Here's how it works. The investors put in a small portion of their own money and borrow the rest from banks. They then use the assets and future cash flows of the target company to repay the loan over time. It's kind of like buying a house with a mortgage. You make a small down payment, borrow the rest, and repay the bank using rental income. In business, an LBO is risky but powerful. If the company performs well, the investors earn a big return. If it doesn't, the high debt can become a problem. LBOs are often used to take companies private, restructure them, and sell them again at a higher value. So in summary, there are many ways a company can divest, and each method serves a different purpose. Voluntary liquidation ends the business and sells everything. Partial asset sales remove just one part of the company. Spin-offs create a new company and give shares to existing shareholders. Equity carve-outs sell part of a division to the public via IPO. Going private takes the company off the stock market. And leveraged buyouts use borrowed money to take control of a company, often to restructure and improve it. Understanding these types of divestitures helps us see how companies manage change, unlock value, and make strategic financial decisions. Now, let's take a look at a very important outcome. How do divestitures affect shareholder value? At first, it might seem strange to say that selling off part of a business can actually increase shareholder wealth. But in many cases, that's exactly what happens. Let's break it down. In most successful divestitures, shareholders receive a large gain, either directly or indirectly. But why does this happen? Let's explore the reasons. First, divestitures often lead to higher efficiency and profitability. When a company sells off an underperforming or non-core division, it becomes leaner and more focused. This allows management to concentrate on what the company does best, its core business. And when a company focuses on its strengths, it tends to become more profitable and more attractive to investors. That naturally leads to an increase in stock price, which directly benefits the shareholders. Second, divestitures often help a company unlock hidden value. Sometimes, parts of a business are undervalued when they're buried inside a larger company. But when that part is spun off or sold separately, the market can recognize its full potential and assign a higher value to it. As a result, the total value of both the parent company and the divested entity increases, again creating gains for shareholders. Third, in some cases, shareholders may receive direct benefits, like cash, stock in the new entity, or special dividends. Let's say a company spins off a division into a new independent business. The existing shareholders often receive shares in the new company. So now, instead of owning one company, they own two, both of which may perform better independently. Or if the company sells an asset for cash, it might choose to return some of that cash to shareholders through dividends or share buybacks, both of which increase shareholder value. Fourth, divestitures often send a positive signal to the market. They tell investors that management is actively improving the company, making tough decisions to eliminate inefficiencies, cut losses, and focus on long-term performance. This builds investor confidence, which can boost stock prices and benefit shareholders. Let's take a simple example. Suppose Company X has 3 divisions, A, B, and C. Division C is consistently losing money and draining resources. Company X decides to sell off Division C and use the proceeds to pay down debt and invest in Division A and B. After the sale, Company X becomes more profitable, the stock price increases, and investors are happy with the company's direction. That's how a well-planned divestiture can enhance shareholder wealth. So in summary, a divestiture doesn't mean a company is shrinking or failing. In fact, it often means the opposite. It means the company is making smart decisions to improve focus, increase efficiency, unlock value, and deliver higher returns to its shareholders. And that's why, in many cases, shareholders receive a large gain when a divestiture is done correctly. In this episode, we covered several key topics related to corporate restructuring. First, we explored what corporate restructuring means and why companies undertake these changes to improve efficiency and enhance shareholder value. Then, we looked at the different types of corporate restructuring, including mergers, acquisitions, divestitures, spin-offs, leveraged buyouts, and going private. We also discussed important classification strategies like forward integration, backward integration, and conglomerate diversification, which companies use to grow and expand. Next, we explained the concept of hostile takeovers, how they happen, and the defensive measures companies take to protect themselves. Finally, we covered divestiture, the process of disposing parts or entire segments of a company, and the various types such as voluntary liquidation, partial asset sales, spin-offs, equity carve-outs, and leveraged buyouts. Make sure to practice plenty of questions from your support package to reinforce what you've learned. Take the time to read your textbook for a deeper understanding of the topics covered. Also, write down notes from this video to help retain the key points. Keep practicing, stay consistent, and all the best in your studies.